Hey there, thank you very much for joining me. One of the more common things is about closing costs. What is included in that, right? We get a number, we all estimate, but really sometimes I feel like we don't even really know until we get into contract. Today, I wanted to go through a closing disclosure, which is a document that you're going to get from start to finish as part of your loan transaction process, which is going to itemize every single closing cost fee that you are going to be paying down to the penny. So we'll go through it. In this case, we're going to use a refinance closing disclosure, but the closing costs are going to be very similar. All right. So this is the closing disclosure. It just means that it's coming towards the end when we're ready to close. $458,000 loan amount, 2.75% interest rate, fixed rate. This is your monthly principal and interest payment. This is not what you get in the mail from us. This is the number that you'll get in the mail from us, this 2232. And that's because this is your loan payment plus your escrow payment. What's included in this escrow payment, shown right here down here, property taxes and your homeowner's insurance. And we'll go into a little bit more about that down here. At the bottom of this document, it's going to pretty explicitly say $9,685 to close this refinance. Okay. How much cash does the borrower have to bring in to close this? He is actually going to be receiving to the borrower $285. And again, we'll kind of go through why that breaks down that way. Okay, but now we'll kind of just jump into the second page, which is all of it itemized. Up front, origination charges. Originators are us, it's Loan Depot. This is what we are going to be charging to process this. The points, these are associated with your rate. What are we paying for the 2.75% fixed rate? In this case, 0.779 points, which is 0.779% of your $458,000 loan amount, $3,567. Okay. I made a video on the rate and points, so if you want to kind of dive into that a little deeper than what I went over, feel free to check that out. Okay, cool. Up next, this is kind of what keeps our lights on at Loan Depot, processing and underwriting fee, right? I think that's $13.50 there. And I want to just caution, this is not something that you want to necessarily go around calling and saying, hey, what's your underwriting fee? What's your origination fee? 1,200, 1,100, 1,800, and then just kind of close the door and base it just off of that. We are going to be building in costs, into these loan points, right? Maybe we charge $250 to originate a loan, and you think, dang, that's cool. But what if we're charging you 1 point for the 2.75? What if we're charging you to get you in the door a quarter point here, right? And you're saying, oh, that's way better than what Shane got. Shane got 779. You're only charging me a quarter. Well, maybe they're charging you $2,500 down here. So it's not necessarily just apples to apples. I am happy with what we have at Loan Depot Hawaii as far as our origination fees. I think they're one of the lower side, including our rates. So I like it. But I just share that just for knowledge, just to know what you're looking at when we're looking at this here. Okay, we're going to continue. Appraisal, right? We got to see what this thing is worth. We're going to charge $650 to the client, but in this case, the appraisal only costs $400. Therefore, we credit him this $250 back here. A credit report, we pull one of those. $19. Flood certification fee. Is your property in or out of the flood zone? This is going to determine whether or not you are required to have flood insurance. Tax service fee. Down here is your title and escrow fee. These are quotes that we pull from them right on day one of you applying for your mortgage. And they come back and say, hey, Shane, for an owner occupant refinance, just regular, we're not going to be changing title to anything. $575 for the fee, $104, $1,281 for the title insurance. Now, if we're going to be changing title, we're putting it into trust, we're taking it out of trust. You were titles or tenants in entirety, and now you want severalty. Those could be different things. If we're not just paying off one mortgage and we're going to be paying off two mortgages and maybe some credit cards with this refinance, it's possible that this adjusts. Every escrow and title company has their own fee schedule, which is available at each of their websites. But anyway, in this case, this is what they're going to charge to refinance $458,000 mortgage. Okay, kind of starting to add this up here. I'm going through it. Another one of title's jobs is to record your mortgage. We need to make record of this transaction so that everybody knows Loan Depot in this case is in the first mortgage position on this property. This is what protects your title, right? From having anything weird on it. Has anybody made claims to your property? Are there any weird liens that you don't know about? We record this and make record of it publicly so that everybody else knows and we are assured, and you as the buyer or borrower, that Loan Depot is in the first position here, and we have now made it known to everybody. It's officially made record of with the Bureau. Okay. Kind of going back to that 362 payment that we were talking about on page 1 is going to be a little bit tied into F and G here. Okay. Because we're closing on July 31st, this is kind of a tough example, but this F section is going to say, hey, right when we close, what are we going to be paying out? And when I say we, I mean escrow. Escrow's job is to be the kind of unbiased third party and pay all these things out, right? They take in the money from us, and then they say, okay, we got to prepay interest to you. We got to prepay some property tax here. We got to pay your insurance agent. We got to pay for the credit report, and it's their job to kind of just make sure that all goes the right way down to the penny. In this case, we're closing on July 31st. We have you pay one single day from just July 31st, kind of a tough example, $34.51 per diem prorated interest. And your first mortgage payment will not be until September 1st. And remember that mortgage payments are paid in arrears. That means your September 1st payment is going to cover the interest and principal payment from August 1st to August 31st, 31st. Okay? But we're closing on the 31st of July. And your September payment's only going to start from August 1st. So we got to pay this July 31st single day of interest, which is why we're collecting the $34.51. If we were to close, let's say July 15th, we would have collected 15 days of this prepaid prorated interest. Okay, and that would have covered your interest payment from the 15th to the 31st. And then you still wouldn't have made an actual payment, that the statement you get in the mail, until September 1st, which would cover 8-1 to 831. Okay. Again, I mentioned property taxes are paid twice a year, February and August. In this case, August 15th for Hawaii. We close on the 31st, so we've got 15 days to make this payment for your property taxes. Okay. Because of that, we're going to collect that 6 months right up front, right? Twice a year, so every payment is 6 months of property taxes. We need to go ahead and pay that. The mortgage servicing company pays your property taxes and your insurance on your behalf. They don't pay it for you. We collect it every month as part of this. This is your loan payment, and then we're saying we're also going to be collecting a little bit of 362 every month. And then it's going to build up in this escrow account, not to be confused with title and escrow, which is confusing. But it builds up in this account. And then when it's time to make payment twice a year or once a year to your insurance, we go ahead and pull from that account to make that payment. But because we're just starting this brand new mortgage, we don't have that escrow balance. And so we need to collect that 6 months up front so we can make the payment on your behalf on August 15th. And that's what this collection is here, right here. This is not going to be included in it. This is a snip that I snipped from the mortgage statement, but just to show, and I'll kind of read it because I know it's tiny, that you have an escrow balance, right, if you have a mortgage. And every statement's, in this case, $1,178, right? That's what your balance is. We're going to have your own balance, but on your existing mortgage, we're going to have to pay them off. That's going to go away. That's still, that $1,100 is still your money, right? But when we pay them off, you have a current balance, $449,000, but you have a balance of $1,100. So we're probably going to be paying them off about $448, and they're going to take that out. But we need our own new escrow account. And that's what this collection here is for. This is going to be paying it just right out the gates. And then this one's going to say, okay, now we got to start building up our own little escrow account here for the next time it comes. And we do that by just collecting a little bit up front. Homeowners insurance premium, 8 months worth. That means every month it's $57. Right? We collect 8 months. What this means to me is he probably has his homeowners insurance premium coming up in probably 3, maybe 2 months. Okay, and so we're going to collect 8 now. We'll collect for the next 2 months as part of that 362, and we'll have a good amount of balance in our own escrow account, and that way we can pay your premium in once a year for your insurance. Also here, hurricane insurance, we're collecting 3 up front, and we're collecting another 2 months of property taxes. All of that together is going to give us a balance, but we are regulated to what we can hold in this account. We can't just collect whatever we want because it makes us happy and comfortable, right? So we say, okay, 8, 2, and 3 months. But you know what? That's a big number, and that's too much. And so therefore, we have to scale that back. So we're still going to say this, but we're going to adjust it down by $354 so that we can stay within what we're allowed to collect from you. Okay? Cool. The total of all of that, $9,685. Right? It kind of adds up quickly, which is crazy. But you did already pay the $650, so therefore the new net closing costs, $9,035. Now this $9,685 is what's going to be shown on the front page, right, that we saw up here. And then I'll kind of get to this in page 3. Okay, 960 net of your $650. That's kind of it for what I wanted to make sure I covered in this video. But if you want to stick around, I'll kind of go through the next process just so we see how we get to this 285 and whatnot. Remember again in that other little snip thing that I had, we had a 449 principal balance on our current existing mortgage, let's call it. Cenlar is the mortgage servicer, but net of that payoff or that escrow balance and also possibly some prorated interest, they're saying that you pay us $448,679 and then we're done and you can get rid of us. And we'll replace that 448 with our new $458,000 mortgage. Okay. And so we're going to give you a new loan of $458,000. Oh, Shane, that's more than what I already borrowed. Okay, so we're going to pay off so that these guys go away and we can replace that mortgage with our 458. So that's that there goes 448 of that. And then we also had the $9,035 of net closing costs. And that's also included in your new mortgage. So for these refinances, you're not coming out of pocket for anything other than the appraisal deposit. In some cases, you don't even pay the appraisal deposit. It's rather common to get an appraisal waived for refinances. Shouldn't bank on it, but you know it's more common than you probably think. But anyway, so in most refinance cases, you're not coming out of pocket to pay for these closing costs. It's $9,000. You already did that when you purchased the place. You're like, oh my goodness, another $9,000? No, this time we're going to let the equity in your home cover this. Okay, so we took out the 448. We paid off Cenlar. We paid for our closing costs. And what's left of this $458,000 is $285, and that's why it is being returned to you. That's your equity anyway, right? And it's really tough for us to get to these refinances where we nail this thing on the head that it's zero, and we just, have nothing back to you. We don't like to, at least personally, I don't like to have anything collected from you. To me, if we're refinancing, it should be kind of an enjoyable experience, and we should have the home and the equity pay for it, right? Different thoughts. I mean, some people think differently, and that's cool. In this case, we worked it out where we got pretty darn close to zero, and at signing, he's going to get a check from escrow for $285 because that's kind of just what's left over from his new loan amount, right? And then this mortgage gone. This escrow balance was net out from his principal balance. We started him a whole new escrow account down here with his new mortgage loan amount of $458,000. When his first payment will not come in the mail and due until September 1st, even though we're closing this on July 31st, because we had that prepaid interest that we paid for, although only for a day, but nonetheless, that's it. Thank you very much for your time. Of course, if you have any questions, please feel free to call, email me. I hope that was helpful. Thank you. All right.